Australia, and this is an executive summary version of a webinar earlier today with Simon Bylsma from Bellmont Securities. It's entitled How to Use Behavioural Finance and SMAs, separate accounts, to attract more self-managed super fund clients. Quick disclaimer, this is not intended to be financial advice or tax advice. Please seek your own individual investor. To be honest, the audience for this is mostly financial advisors and other financial service professionals. So what did we go through in the session? Well, we talked a bit about self-directed investors, the people who are perhaps reading the financial press, they're making their own investment choices, choosing stocks to buy and sell. We talked about how they can tend to be overconfident, and as a result of overconfidence, there can be a range of risk management issues, both in terms of sort of retirement planning, insurance, risk management, portfolio diversification, and the like. And you might think that that leads to a bunch of opportunities for an advisor to really add some, but unfortunately also overconfidence also leads to a low perceived need for advice. So I need to talk to an advisor if I can do everything myself. How can I trust that other people can make better judgments than I can? So the point of this session was to say, well, what's the solution to get over that barrier and try and help some of these clients? And what we're going to look at is some of the tax issues associated with overconfidence, some of the things that can be overlooked, and that as a bit of a leg in to help clients in different ways. So one of the insights we looked at was really, what does overconfidence mean? How's in the psychology, behavioral finance literature, and what does it mean for investment decision making? I won't go into it in detail here, but effectively what it means is that overconfident investors, in particular males, are more likely to trade more frequently, and unfortunately, more frequent trading tends to lead to worse returns, both for individuals and for professional investment managers. But not only does it lead to worse returns pre-tax, it also has potentially significant tax implications as well. And I ran through a scenario here where we're looking at the same portfolio with the same returns, the same sort of stocks in it. All that's changing is the frequency of trading. And what we've done is we've generated here a $200,000 tax cost from more frequent trading relative to a simple rebalancing strategy. Now that scenario is just one of many, because there's plenty of other tax consequences that can easily be overlooked. These are perhaps less salient. They're not the things that strike us. They're not as salient or as vivid as the nightly news and all the reports about what's happening with the company strategies and industries, rates and the like. But these things can be very material in terms of long-term after-tax outcomes for investors. And Simon Bylsma ran through this list. Many of them are very relevant for Australian equities investments, franking credits as a good example, and some of the corporate action strategies as well. And many of them pertain to direct equity ownership rather than purchasing units in unit trusts, and how you can, from some of the tax strategies in having direct ownership of those underlying securities. So then we went back and said, okay, let's revisit where we've come from and the problem we had with risk management issues, the barrier of low perceived needs for advice, and these issues. And really the thrust of this session was to say, well, if we start addressing some of those tax issues, and if we can deliver advice and investment solutions that can overcome some of those tax issues, then that might be an avenue to start engaging with some of these types of investment clients. It's also an avenue to potentially engage better with accountants, whether those are accountants who are in combined accounting practice, for example, or maybe they're external referral partners or centers of influence. And once we've started to engage around some of these tax issues, then potentially there's an avenue then to use that engagement, to use those relationships to start broaching some of those broader risk management issues. So then we took a step again and said, from my perspective, as an independent consultant to the industry who deals with sort of understanding the psychology of investment decision making, what can I do? Well, actually, I can't do a great deal by myself. I can raise awareness. I can help people to understand and try and overcome some of these sort of decision making issues. But really, you need practical investment solutions that can be delivered to clients to help them down this path. So I talked about the solution that I look for when I went out to the marketplace to say, well, here are the issues, what can we do about it? I look for someone who could deliver direct share ownership to capture some of those sort of direct benefits of owning shares. I needed to find something that was low turnover to manage the capital gains tax consequences. It had to be able to break some of those barriers to the lack of trust that self-directors often have for professional investment management solutions, and there's various strategies to do that. Had to be simple and easy to understand, low cost and flexible. So we talked a little bit about how between Behavioural Finance Australia, my business, and Bellmont Securities, we actually can capture both parts, the sort of client engagement, decision-making piece, and how do you as an advisor talk to them and engage and perhaps attract more clients or work better with referral partners, position the value of advice and that sort of thing. But then also partnering with a very easy, low cost and tax-aware investment solution as well. So then Simon Bylsma ran through a couple of scenarios about how this can work in the context of a financial planning business, or in the case of a dealer group with a number of advisors in that group, and highlighting some of the issues, but also highlighting how the approach is relatively flexible and can accommodate different businesses with different objectives and different client needs. We then answered a few questions, and I directed the audience to sources of more information, one of which is my recent book, Applying Behavioural Finance in Australia, which people can view details of on my website, www.behavioural.financeaustralia.com.au, and it's available for purchase on Amazon and major retailers. And for further information, they're more than welcome to contact the two presenters, myself, Simon Russell, Behavioural Finance Australia, and Simon Bylsma from Bellmont Securities. Our contact details are there. Please feel free to drop us a line.